I hear from most members that they're happy, but what a minority of them say, which is frustrating to me, is they say, I'm kicking myself because I'm looking at these recommendations and they clearly have done very well, but I didn't participate because I was too nervous, I was too scared, I'm too anxious about the future. And so I try to make clear to all members that there are a number of things that we do to reduce your risk, that you don't need to be afraid to participate in the recommendations that we're making. And then we just talk briefly about 3 of the things that we do that are a key part of our strategy. The first thing is everything at the Oxford Club starts with our asset allocation strategy. Your asset allocation is how you divide your money up among different non-correlated asset classes. Non-correlated means they don't all move in the same direction at the same time. And the asset classes are large companies and small companies, foreign stocks and domestic stocks, high yield bonds and high grade bonds, inflation adjusted treasuries, real estate investment trusts, and so on. And we have a pie chart in the communique and on our website that shows you how you should divide your money up. And we say that, for instance, you shouldn't have more than 60% of your total liquid portfolio in stocks. So from that standpoint, you don't have all your money in the stock market to begin with.
Right.
Then, after you start to buy the individual recommendations, we always suggest that members use our trailing stop strategy. And that's very simple. In the communique, for instance, we use a 25% trailing stop. That means if we recommend a stock that's trading at $20 a share, as soon as you get your buy confirmation, you put a sell stop in at $15 a share. And of course, we're hoping the stock goes up, but if it goes against us, you would never take more than a 25% loss. And if it goes up, you would keep raising that stop to protect your profits so they don't end up slipping through your fingers. If the stock goes to 30, your sell stop would be 22.5. If the stock goes to 40, your sell stop's at 30, guaranteeing you a profit, making sure it doesn't get away from you. So that again reduces your risk. And then a third thing that we do that is not talked about as often as it should be is our position sizing strategy. And that is, we suggest that you not put more than 4% of your portfolio in any one stock initially.
So if you have a $10,000 portfolio, a $100,000 portfolio, you're not going to put a huge majority of that into any one of these
stock.
picks. Yeah.
Sometimes I have members come to me and they go, I put my entire IRA in that last recommendation of yours, and I go, I know they mean it as a compliment, that's not what I would recommend. You want to spread your bets, not only to reduce your risk, but also to give yourself a better chance of having a big winner. But if you start with 4%, remember the stock could become a much bigger percentage of your portfolio. If you put 4% of your portfolio in Apple 10 years ago, it could now be half of your portfolio. But that's okay, because if you're running the trailing stop, you're protected. Otherwise, it'd be crazy to have half of your portfolio in one stock. You would never start off by putting half in one stock. But this way you can protect your profits. And there's all these different things that we do to encourage people to participate in what we're doing. Everything we're buying is high quality. We're asset allocating the portfolio. We're running trailing stops. We offer a position sizing strategy. And we have white papers, special researcher papers that are free, that are posted on our website that people can access at any time for a full explanation of how these various strategies work.
How, for experienced members, people who've been with the club for a long time, they've been with us through the ups and downs of the market, and they know that the strategy works. How do people who are new to the Oxford Club get past that point where they feel like, well, I just joined and I'm starting to put my stock picks into my money into work here, and I just know that as soon as I do that, the market's gonna tank, and I'm gonna be stopped out.
Well, quite frankly, it could. No one knows for certain when the market's gonna have a sell-off or how long the sell-off will last. And so I would tell a member who is new that they should start with an amount of money that they're comfortable with, get their feet wet, purchase the stocks, run the trailing stops, see how it works out. And if your experience is typical, you're going to be more comfortable following more of the recommendations and becoming a long-standing member of the club.
And then part of this is the stock selection strategy that you employ. You are picking high-quality stocks, high return on equity, accelerating earnings growth, these sorts of things, which really put the odds in our favor, regardless of what the overall market is doing.
Exactly. We're not recommending risky penny stocks or unprofitable companies, or companies that maybe they are profitable but their earnings are going down instead of up. We're buying very healthy companies whose prospects are excellent. It may seem counterintuitive to some people, but a stock that's rising, maybe it's even at the high end of its range, is a much safer investment than a stock that's cratering, because that stock is going the wrong way, because behind the scenes, or maybe right out in the open if the stores are empty, it's going through a tough time, and that's reflected in the share price. So it's not like merchandise in a store where it's marked down, now it's a bargain. If a stock is going the wrong way, good things are not happening at the company, or something's amiss. So that's another factor that reduces our risk, is that we're buying very high quality companies. So the quality, the diversification, the asset allocation, the trailing stop strategy, the position sizing, these are all measures to reduce your risk and still give you unlimited upside potential with your portfolio.